Good morning, everybody. And thank you for the introduction, Madison. My name is Damon Watkins. I'm the Director of Finance and Operations for the Cal Poly Center for Innovation and Entrepreneurship. I work with the SBDC as a consultant in financing, accounting, and QuickBooks, specializing in those areas. Today's session is actually about year-end preparation for year-end close and what that looks like. But before I start with that, I would like to just touch on some highlights in regards to what Madison said. The SBDC is a program that's run by state and federal grants through the CIE. It provides free consulting to local businesses and startups in our community. We have over 42 consultants that are available on hand to help businesses in this way. That consulting is completely free and funded through these grants. The reason for this is we understand that these small businesses are the lifeblood of our community, and making an investment in them and keeping our jobs and our tax revenue in our community is how we keep this little slice of paradise going. Spreading the word about what we do and the fact that we're here is sometimes the biggest part. So after today, please tell your friends, please tell your family members that we are here to help and assist in any way. And if you are interested, don't hesitate to take a look at the SBDC website. With that said, let's talk taxes today. So let me start by talking a little bit about me, so you know who the guy is actually presenting here. I've been teaching QuickBooks as an advisor for 25 years now. I've run budgets for QuickBooks with companies like REC Solar here in town that ran a $250 million budget through QuickBooks. So that kind of answers the question from a scalability standpoint, unless I see you guys getting there anytime soon. QuickBooks can pretty much handle anything you need to do. I've worked for local wineries in town, including utilizing QuickBooks to deal with things like compliance, tax payment, multi-state tax payments. So again, QuickBooks has the ability to manage and do a lot of these things. But the key aspect, and I seem to run into this every year because I actually teach 3 different classes. I teach a beginner's class, an intermediate, and then a tax reporting class. And each time I taught this class, what I tend to find is people know what they need to do as in regards to completing their tax returns, but they don't necessarily know what they need to do to close out the year and ensure that everything else is in place so that they can file. And that is a lot of what today is. So though we're going to talk around taxes, I'm actually going to talk about the key things that drive your reporting and things that you should be doing regularly. Now, the reason I go about it in this manner is taxes relate differently to every single business that's in this room and to any individual that's online watching this meeting. And one of the things I don't like to do is sit here, put a slide deck up on the screen or on the PC for people out there and just talk and click, right? Because all I'm doing then is giving you guys a lecture. So at Cal Poly, we're very much about learn by doing. So we're going to do some incremental states. I'm going to walk you through certain procedures that you should be doing. You're going to give me your feedback on questions and answers, and then we proceed through. The reason I like to go about it this way is the only way you learn and grow is by questioning, asking, and understanding. And that's the key premise of what we're doing today. Couple of small reminders. Everything I show you in documentation-wise will be sent out in a summary email afterwards. The sessions are being recorded. If you want to go back and review a certain section or review some of the classes that I've done in the past, they are available on YouTube. Please, please, please don't hesitate to stop me. Put your hand up. Seek to understand. There's about 90 minutes of content that I have. I leave 30 minutes afterwards to see if you have additional questions, want to set up an appointment, have specific things that you want to talk about. But the best way this works is for you to interact with me as it relates to you. So if something doesn't make sense or you can't understand it, pause, ask, clarify, and then let's move forward from there. So let's talk about taxes. Most people, when it comes to QuickBooks as a startup, run to a CPA first of all when it comes to taxes in those first couple of years, only because they don't have a clear understanding of what they should be doing in QuickBooks as it relates to taxes. Taxes is a scary word. It really is. I get it. But QuickBooks makes it very, very easy to actually do it yourself, whereby you're only interacting with your CPA once a year when you're handing off those financials. That's what today's all about. Okay. So I'm going to start with something really, really basic, and then we're going to kind of work our way through. So we talk about vendors, we talk about customers, we talk about payroll. I'm going to stay away from payroll today, though we can touch on it. And then we talk about ownership, right? Owners of the business, owners, drawers, disbursements, things like that. This ties back to your S Corp and your C Corp question, just so you know. So when we're looking at this from a tax perspective, each situation is treated differently, but the process we go through each month to close out our books and prepare for the next month is what prepares us for our year-end close. So the very first thing that I'm going to bring up and I'm going to talk about is not taxes. We're going to talk about your chart of accounts. Why do we start with our chart of accounts? Well, it's really important that we start with our chart of accounts for one simple premise, right? Our chart of accounts is where we're coding those expenses to, which in turn is driving our tax reporting from an income, revenue, and expenses standpoint. A direct offset for our revenue is our expenses. If we're not capturing all these expenses, what are we paying more in? Taxes. Okay. So you're like, Damon, why are we talking about reconciliation when taxes? Because I want people to understand that the better understanding you have of the expenses coming in and where they're being coded, you're paying less in taxes. I'm assuming right now that you have your bank accounts linked up, you've got your chart of accounts established, and you're coding to these directly. Not only am I assuming that, and we need to stop if anyone's not, because we'll start down a different path. One of the things I really like to see that you should be doing to prepare for this is your month-end reconciliation, okay? Every company, no matter how small, how big, should have a month-end close procedure. I don't care if you're a one-man operation or a 50-man operation. Go right ahead.
So when you say closing out, are you referring to all of your accounts, like your checking, savings, credit card accounts, or is there another closing out that you're referring to?
No, it's reconsolidating the outstanding accounts, primarily your checking and your credit card, to ensure that you captured those expenses. One of the issues we tend to encounter in this area is capturing the expenses in the month that they didn't happen. Because of the simple fact that you get a credit card statement the next month, you're then sitting there posting. Expenses should be captured in the month that they're taking place. That's part of the reason we have a closeout procedure. So traditionally, you would have a 3 to 5 day closeout procedure after the first of the month. It gives you 5 days to close out, reconcile the balances back to the bank account. Anything after that period of time does not get coded back to that period. So let's say you get a statement on the 22nd. Somebody forgot to send you an electric bill, and it's for that prior month that you've already closed out. You would not apply that bill to that month, because the moment you did, you'll go out of balance. And then when you go to tie out the following month, you'll be out of balance. And so having a clear, concise closeout procedure so that you follow it every month, irrespective of, will set you up for success moving forward. Because what tends to happen is people have these closeout procedures, but then they don't lock things out. Who actually locks out their financials here? Nobody. Like, it's not common for people to do it. And here's what happens. You close it out. 3 months later, you get a bill from 2 months ago. You go back in, you plug it, you won't tie. Because that transaction didn't happen in that month and the bank knows it. And so then when you go to tie out, why is that so important? Well, if you miss 1 month, sure, that's okay. If you miss 2 months, maybe. But here's what happens. You get to November and you go, I haven't reconciled anything this year. Okay, let's go back and reconcile. What makes it that much harder? 11 months later. That directly affects how we're going to do your tax reporting. That directly affects how your P&L looks. So something so small can have such a huge impact. And so I run an incubator or work with incubators and accelerators in the hothouse as well. And these are two of the team members here that have gone through our program. One of the very first thing I teach them is that I only need you to put about 25 minutes into QuickBooks a week, right? I literally tell them, if it's set up correctly and you're doing it right, you don't need to. Right? But you got to have it set up. You've got to be reconciling it. You've got to be doing these little things. So I start with that because everything that I talk about after this point, if we're not doing that, it's not going to tie and it's not going to balance out. And I can't overstate or understate. The other part of this that's so important, going back to the expenses side, is your one source of truth in many ways is your bank. Every transaction's hitting there and then showing up in QuickBooks, unless your credit card. It ensures that you're capturing all those expenses. I mean, like literally saying to you, here's your balance in QuickBooks, here's your balance at the bank. We're off because you didn't get this expense, and this expense. And so ensuring that we're capturing all of this so that we're not paying too much in taxes is what I'm trying to convey from this point of view. And so I would hope that we have our chart of accounts set up with the line items that we're capturing those expenses against. And specifically, we're taking the time each week to go in and ensure that they're coded correctly.
I wanted to ask things that don't hit the bank account, like fees. Are you including those like on a monthly basis, or do you do those sort of
love that question.
quarterly?
Yeah.
And how long do you spend either tracking those types of things down? I heard you say maybe 25 minutes a week type of
Yep.
thing. So just wanted to
Sure.
put that in there.
So first of all, great question. This happens all the time. I get this a lot. So we have a lot of teams that have things, we have a ride service. Somebody started a ride service where they have hundreds of rides going out, taking college students to different parts of the campus. And they have transactions that flow through, pick somebody who, Clover, whoever, that speaks specifically to what you're talking about, whereby the transactions hit the bank account, but the fees associated with all those transactions become a real issue because they are an expense, but they're not always captured in there. And let's say you did, in their cases, 100 rides a month. Are we going to say that we're going to create 100 line items? No, we're not. But the process there is actually pretty simple. So internally, what we have decided to utilize is we simply go back and we treat that bill, those expenses associated with the transactions, as a vendor. You establish them as a vendor in the system. So let's say we use Clover, right? And at the end of the month, Clover send me a statement. There's 232 line item transactions, and they give me a big fat number. That's your answer.
You do it with this statement.
You just do one transactions against one line item because it's still a consolidated expense. You do not need the granular detail. If you did, you could log into Clover and see every transaction, but from your side of the world, capturing it as one expense. And this becomes troublesome at times because what a lot of the teams were doing, where they were going into their invoice and then putting in it after the fact. Well, imagine having to go into 100 bills. It just, from a time perspective, it doesn't make sense. Again, utilizing your time more effectively, you can grow your company, be more productive. Does that answer your question? Great. And everyone runs into this, and that is the best way to handle that situation to ensure that you're capturing, because the other part is when you piecemeal it out and you've got 100 transactions, you need to make sure you got 100 in there. When you're doing it that way, you're tying directly back to the statement. You can upload it into the system. You can attach it to that bill, and then you can pay it, and it's captured right away.
What if the actual transactions that you get for each customer and that bill crossovers into 2 different months? Does that matter?
So yes, it does, depending on your company and whether you're using a cash base or accrual. Going back to your S Corp question again, the advantages of an S and a C Corp. It would depend the mechanism that you choose to set up. I mean, if you know that those transactions took place and they just haven't hit yet, you could create an accrual account and create a small accrual for it for that period of time and then post it once it falls into the following month. The other part, if it's an insignificant dollar amount that we're talking about, where it's crossing from the 29th to 3rd, then it's a miscellaneous. I mean, it's below a $5,000 mark from an overall transaction. I would not be as concerned at this point in time from that perspective. And there is always that lag because those fees, that statement you're talking about always comes like the 10th of the month anyway. So you normally have this transactional statement coming post-close as it is. It's just how you want to capture it. If you're always capturing it a month afterwards, that's fine if that's your procedure. Remember, an auditor's perspective is he always looks for patterns, and his red flag is when he doesn't see the pattern. So if you're doing that every month and you can justify it, they're great. But when they see something and you can't justify it, that's when you get yourself in trouble. So from this perspective, it sounds like the way you're going about it is absolutely adequate for now. We good on that one? Okay. So learn by doing. We're going to do lots of interacting, talking about things, and then going back. We're going to jump into QuickBooks with questions showing you what QuickBooks actually does. But we're going to spend a lot of time talking about these things because it's really important that we understand the relationship between the two. So the first place I'm going to start is at a really high level with vendors. Okay. Why are we talking about vendors, Damon? Well, within vendors, we have subcontractors. Who here deals with subcontractors? Great. Benefits of subcontractors and not dealing with them through payroll. We don't have to pay payroll taxes, number one. Great for us. Number two, tax reporting liability falls on who? Falls on the contractor. So when we give them the contractor, scope of work, defined pay, defined period of time, right? The tax liability associated with that transaction is on the contractor. It's their responsibility to report what they made or earned doing that project, and it's their responsibility to file. But there's one caveat to that. One really, really important caveat to that. They have to be marked as a 1099 inside QuickBooks. what do we need to have on hand to mark them as a 1099? This is a trick question. Does anybody know the answer? No, we have to have a signed W-9. If you do not have a signed W-9 on file, whose responsibility is those taxes? Okay, so January 30, you have to have your 1099s generated for your vendors, okay? If you do not have your 1099s generated for the vendors, that responsibility falls on you. The way that you ensure your vendors are set up in QuickBooks is to mark them as 1099s. I'm actually going to show it and show you guys how that looks. This tends to be really, really important for startups, because a lot of the time companies like that are bootstrapping themselves to grow, and they don't have the revenue or the income to support themselves. So by utilizing subcontractors, the responsibility and anything to do with taxes falls on them, and the system gets to capture them as a business expense. You're not dealing with payroll taxes. You're not dealing with FICA, any of those associated with it. So it's an instrument short-term for small businesses growing to utilize individuals to get work done that can be claimed as an expense against the business without incurring any payroll taxes, because we're not running it through payroll. Okay, that's not to say we wouldn't at some point later, but the key point that I'm trying to convey here, can you show my screen on the, or do I have to share? Okay, sure. There we go. So I'm bringing up the screen just showing the vendor page because I just want to make really clear what it looks like. There we go. Okay. So when we're setting up a vendor, basic information needs to go in here. And specifically as it relates to your email address, contact point. But the most important part is this little section. It will let me scroll down. Right here. Track payments for 1099s, okay? If that box is checked when you set up and you've uploaded that W-9 into the system, you're good to go. Here's one rule. Do not issue a payment to a subcontractor without a W-9, period. Because the moment you do, you know what you will struggle to get? A W-9, okay? Any subcontractors you deal with, whether it's a student, whether it's a business, whether it's an entity, and you're utilizing them as a subcontractor, you want to sign W-9, you want it on file. That way you can claim the expense, and that way you can issue out 1099s. Go right ahead.
So is that for any vendors that you pay more than a certain amount yearly?
No, this only applies to specific vendors that you are utilizing as subcontractors, where it's defined work and defined pay. So what is a subcontractor is really the question you're asking me. A subcontractor who's someone who is working for you independently to do very specific work at a specific rate over a specific period of time. They are not per se vendors that you interact with traditionally, where you're buying something physical from them, a service or a product, and receiving it. These are people that are actually working for your business, doing work that relates to your business in some form or manner. Yes.
Would that include like consultants, accountants, CPAs?
So the consultants could be, but CPAs cannot. No. Because the work that CPAs are doing for you are specific to a requirement, where the work that is done through an independent contractor, you dictate and decide. And so that's what the clear definition is, that what differentiates them between skilled professionals that are doing specific scopes of work for you and defined scopes of work and defined pay for a period of time under a subcontractor. And all of this is broken down in subcontractor agreements, and you can look up, there are templates out there for days in regards to this. You had a question.
You can answer it. Is the difference between contractors?
Yeah, the vendor side. So subcontractors are just that. They're working for you specific to the work that you want completed that's clearly defined. I mean, the consultant part gets a little vague because technically, I suppose a consultant could be a subcontractor in some manner, but that gets a little tricky there. Are we clear on the vendor side? What we need to do to make sure that we're not paying taxes on certain situations and we ensure that these are set up correctly? Yeah? Okay. The last part before I leave this, I'm going to touch on this really briefly. If it doesn't relate to anyone here, great. If it does, even better. I'm going to talk about resale certificates, okay, in California specifically. This does relate to taxes specifically as a flow-through scenario. Does anyone here know what I'm talking about when I bring this subject matter up as a resale certificate? Go right ahead.
Like if we bought something, we could either pass the taxes on to the customer or we could pay the taxes on them.
Correct. So this relates normally to when we specifically talking about a product that we're producing. The best example that I can highlight out there is a construction company, okay? So the state of California does not want to incur double taxation. More importantly, companies don't want to incur double taxation. So let's say I'm building a house, okay? And I buy the wood and I buy the tiles, right? But when that house sells to whoever that third party, the taxes are going to be incurred at that point in time. So when I'm buying the wood from Home Depot or I'm buying the glass, I don't want to pay taxes, right? So I complete what's known as a resale certificate, right? This resale certificate allows me to then pass those taxes along to the end entity that will be then selling that product. The reason this can be important to you is if you are producing something, right, you could limit the taxes that you incur against that product by utilizing a resale certificate. Now, the way it works is you have to reach out to each of the vendors that you are dealing with and purchasing the product from. They will send you a form, a resale certificate, that then you need to complete with your EIN and relevant information, and it's submitted back to them. A copy of that then goes to the IRS, and that's how we are able to utilize resale certificates. Go right ahead.
You mentioned construction. What other industries is this sort of common in?
Anything that puts a product together that is then resold.
Okay, so like jewelers, I'm just thinking
Jewelers
like
would be a
makers,
great example,
crafters,
yes.
artists, that kind of thing.
Because you're buying the raw material
Mhm.
that you're then paying taxes on, producing something and selling that and then paying taxes on that again.
Right.
And so that would be a clear distinction. Now, the question that comes up in, let's say, the jewelry scenario as a specific is, are you buying the raw materials, producing something, and then selling it yourself, or selling it to someone else who's then selling it on your behalf? This is when the complexities of what's taking place with the resale certificate come into play. Because the first scenario, you're not. You're producing it, you're making it, and you're selling it. So you're incurring those taxes there. But if you were to produce something, give it to a wholesaler who then went out and distributed, completely different scenario again. So understanding the relationship between the two is what we're talking about. The other part is, are you doing it here in California? Much to what you talk, or are we doing business outside California where we have nexuses that we then need to report on? So again, you'll notice that I'm going really, really small with taxes, but all of this relates to taxes. Most people just don't know it. They're not questioning it. They're not understanding the relationship between a 1099 for a subcontractor and what you're paying on income tax at the end of the year. But there is a direct correlation between the two. Right? We just need to understand it in our mind so that we know, yep, I'm doing that. I'm generating my 1099. Ooh, that P&L is looking good. Because take that tag mark off your vendor and then go back and look at your P&L and see what it tells you, right? All those expenses are going to be treated completely differently than as if they are tracked under a 1099. Are we really good on the 1099 part? Tracking? Yeah? Okay. Now we're going to jump into a little bit more fun side of things. We're going to talk about the sales and use tax sides of things. Now, anyone doing business in Hawaii? Let me just throw that word. No. Okay, good. So one of the few states out there where legal double taxation actually takes place is the state of Hawaii. You have something called use tax, which means that they are charging you for the right to work or utilize Hawaii as a place to do business. Well, what does that actually mean to you and me? I'll explain it as simply as I can when it comes to use tax and Hawaii as it relates to everyone else. And if you never get to deal with it, then you've just learned something new. Most places calculate taxes as a percentage of a total. So I spend $15, I charge a 10% tax on this $15, that's $1.50. That is not the way that Hawaii works with use tax. If you buy something for $10 and get charged $1.50 tax, right? So you're at $11.50. They charge you the use tax on the $11.50. It's the only state that does that, okay? And it's very, very unique to them. So when we do reporting around Hawaii, it gets a little bit more complicated. QuickBooks does have the ability, but if you're not dealing with Hawaii, you just learned something new today, and you don't have to worry about use tax here, at least for right now.
So if I sell a product to Hawaii and send it to them, am I responsible for collecting that?
Yes, you are. Yes, you are.
Similar question online, but couldn't either because, what if I have a customer in Hawaii buying a software subscription?
Oh, so subscriptions are different. So this is where we come down to services and products. This only relates to products, so something physical. So as it relates to service and subscription, you do not need to worry about use tax. It only relates, and specifically, it's a product landing on the mainland. That's where this tax is being incurred. When a product ships over there and hits the mainland, that is what is incurring the use tax associated. So if it's a subscription where it's service-based, no taxes associated. Think of it the same way when we're inputting taxes on what we're selling to a client. We don't put taxes on services, right? If there's a line item within there, there's no taxes. But if it's something tangible and physical, there's a tax associated with it. And that's the best way to think about it in your mind's eye. From a tax perspective, services, we're good. Products, something physical, we're going to be taxed on it. Great questions. Great question. Please keep them coming. And if we want to have a different path that we're going down with these questions, keep them coming. This is the best way for us to put the dots together, to paint this clear picture of what it's going to look like. Because at the end, when I show you the tax accruals that I've created in here and how they're going to be dispersed, all of it ties back to what we're talking about right now. Okay. So let's talk about, actually, I'm going to bring up the chart of accounts because I want to talk about states. So who currently is tracking their sales tax within QuickBooks? Excellent. And so have you set them up by the county per se, and you've got the fixed rate in there? And the system pulls in the rate automatically for you?
Yes, I do it out of Napomo unincorporated, so it's a flat 1.25% to any clients in California only.
Correct. Let's see. So the reason I bring this up is, do we all understand how taxes work? And I'm talking at a really high level, right? We've got state, we've got county, and we've got city. Those are the core that make up our 8.25% that we have right now. The bulk of it is for the state, about 5.5%, right? Then it's the county, and it's about 0.5%. If you're downtown like us, you're actually at 0.75. Those are what makes up that total in taxes that we pay. The reason that part's important, and I'm not going to get to it today, but if we meet after this, I'm going to walk you through this, is part of what I do in going through this process with you is teaching you how to do your reporting to the BOE. Now, who here has registered themselves with the BOE? You and I were talking about that. Okay, great. So we're doing our quarterly filings. We're doing our estimates already, our projected estimates. Yes, no, no. Okay. So we're doing annual filings. Perfect. Okay. So annual filings taking place, tax accruals taking place. We still need to do our estimates at the beginning of the year. All of that is captured within QuickBooks. And then we have to go log into the BOE, the Board of Equalization for California, right? And the first thing it says to you is, okay, great. You're here. You want to file your taxes. How much did you sell? And you punch in a nice little number. And it goes down beneath it and it says, okay, now tell me the counties you did this business in. Okay. And the point I'm trying to make here is it's really important that you have that set up correctly in here. Because if you have all the counties broken up when you're invoicing the client, it's going to automatically capture that reporting so that when you simply log into the BOE and it asks you for the breakup, it's already there for you. It's that simple. Go right ahead.
Just want to mention in my case, I have our warehouse where we live in Napomo. And so no matter, from my understanding, no matter what county I am shipping product to in California, it stays at the rate where my product comes from, 7.25%.
Correct. And that is called Nexus. right? When you establish a nexus in an area that ascertains what that rate will be, the only time that's going to shift and change, and we touched on this briefly earlier, is when you do business out of state. And depending on the amount of the business and where you are sending that business will dictate where the other nexus, the state that you need to report in next. So let's talk about that really quickly before we get into actually Craig's designs, landscaping services, tax liability, sales tax liability. I do want to talk about multi-state reporting. So a couple of things on this level. Once you got to that point where you're starting to do multi-level reporting, the complexities and the time demands shift. Okay, so first thing, my first recommendation in regards to this, because this is a mistake a lot of small businesses make, and I was really glad to hear you say these particular words. You said, I haven't got to the revenue point where I'm doing business in those areas. And the reason for that comment being so important is it costs you money to do business in other states. You don't just get to go and send your product to that state and go, yay, I selling in North Carolina. No, it doesn't work that way. You have to register in that state. You have to register with the Secretary of State in that state, and you need to file in that state. And their filing requirements might be different to California. They might demand that you file monthly, quarterly, semi-annually. Go right ahead.
But is that true only when you get to a certain level?
Yes. And that level can be dictated by the amount of revenue that's generated. Normally, I like to say around that 5,000 to 6,000 mark, we're starting to have that conversation. But the point I'm trying to make here really, really clearly is if you're looking at North Carolina and going, oh, that client, we're going to do $500 a month with that client. That's not worth your time. Why is it not worth your time? Well, it's going to cost you more to register and do the filing in that state than the $500 that you're getting from that customer. So before we go into these states, we want to really make sure that that state's filing cycle works with the business that we're doing in and justifies us doing business in that state. Sometimes being small businesses, we're so wanting to expand and gain those other markets that we don't look at the financial impact to our business. Now, if we know that we want to penetrate a market and we're going there to grow that market, we're having a completely different discussion. But if we're talking about somebody reaching out to you to sell you a product in a state that you're not registered yet, and you want to do it, you need to think of the financial consequences from a tax reporting perspective.
What if you had a sub-distributor under you in that state?
And this is another way to get around these things, because they would be, depending on how you structured them and set them up, subcontractor, vendor, distributor, you can take advantage of that. And that is a way that a lot of small companies utilize distribution networks to solve for that issue. Do note, what's the downside? What do they want from you to do it? So you give up money and you give up control in two areas. They want a percentage, so your margins declined, right? And they want control. They normally want inventory on hand of some form that can then be distributed out, which means you're incurring costs as well. So yes, it's a solution. Is it the ideal solution? No, but it could be a vehicle, right? To get you from this point to this point whereby you build up that base and then you're distributing to them directly. Great questions. Yes.
How would that work in the context of like a e-commerce business? Let's say that I am selling t-shirts or, for example, something along those lines in different areas. How would that work?
So depending on the volume that you're doing and depending on whether you're working directly with your customers and sending those directly to the customers or working with a distributor. So the nice part about the distributor is depending on the relationship that you have and how it's structured, you're either basically selling the product to him at a discount rate that he is then going out and selling on your behalf. So you're incurring a single cost, or he's holding it on consignment for you and selling that product, at which point you basically have an inventory control system that on a monthly, he's sending you a report that you're then reducing, invoicing for, and repeating. Again, the difference between the two is the distributor is the registered business entity in that state. And so as such, that responsibility falls on him. You're just dealing with the gross sales that either go to him via a discount or if he is holding it in some form or manner to sell on your behalf. So it depends on the structure of the relationship. Is it a partnership? Is it a subcontractor? Is it structured specifically as a distributor? This comes in a lot with wineries, deal with exactly what you're talking about.
Could a third party distributor, would that also include things like software? Like, so if it was like Etsy, Amazon, like those kinds of platforms?
Yes.
Is that another way to think about it?
It is,
Okay.
but be careful with the online because if there's still a physical product involved, then you're still going to have to deal with the reporting side of things. And just so you know, the IRS as a whole is taking a far closer look at this because it's a huge black hole. It's kind of like the Airbnb black hole that they finally filled, right? Whereby they actually now withhold taxes on Airbnbs as a whole. They're going to do the same thing with the online mechanics. It's just a matter of time. I mean, they've already did Amazon 2.5 years ago. It's just a matter of time before they get to Etsy from an e-commerce perspective to answer your question, because people are utilizing it in that manner for that very reason.
Yeah, okay.
Yeah. Because the thing that I've come up a lot of times, just so everyone is clear, is that resale certificate thing. A lot of people have started Etsy business and then they come to me and say, well, can I utilize the resale certificate for my Etsy business? And if you're not the primary seller of that product and you're selling it to somebody else who's then yeah, technically there's no reason. But that's a huge caveat right there that you're creating from a tax reporting perspective. And it's completely legal, but you have to be clear that the IRS are well aware of that and want to close that loop. Because there's a whole lot of e-commerce taking place that they're not capturing anything from a tax reporting perspective. So does that answer your question as a whole? And we can spend some more time going down this because it's definitely a model that you're going to look at as you guys look to expand as well. Wow, we jumped back and forth there. Any other questions between online before we just take a look at the Arizona Department of Revenue? I love Arizona. The reason I want to just really take a quick look at this with you guys is I just want to show you from a tax. So we all know how to generate an invoice, right? We've all set up the counties. We've got the tax accruals taking place. The nice part about this report is, so just to be clear, when I started doing this, QuickBooks did not have the ability to map over the state rate at all into QuickBooks. So you used to have to go to UPS, the postal services. So that's where the rates are actually tracked. They're tracked by zip codes, and it's the postal office that updates them. So 5 years ago, QuickBooks didn't have it. We used to use a program called Avalara. It's a great program if you want to use for your tax reporting and for payroll processing. But you had to do it manually. You literally, I'd get an alert from the BOE saying rates have changed, how many counties there are in California, and then I'd have to go in and update every single one of them. And the worst part is the IRS does not accept ignorance as an excuse. So if the rate moved from 7 to 7.25, and I accrued it at 7, and when I went to file it, they came back and said, we sent you the notification. I was like, I didn't see that email. They're like, we don't care. So ignorance when it comes to filing is never an excuse. It is your responsibility to be informed, on top of it, and clear in what needs to take place. That is part of why we're doing this. Because you may have pieces of the pie, but completing that whole picture is key. And this is what it looks like when you do it correctly. I mean, we've all seen this report, right, from an overall perspective in regards to it. Now I can go in and say, yep, Arizona State, Tucson City, $8.44, down to that level, okay? BOE's happy, hit the button, make the payment, life's good. It's literally that simple if we set it up and do it correctly, right? Let's talk about the rates in California really quick. County by county shift, right? The system will automatically pull in the most up-to-date rate based on the street address that you input in the system. Why do I highlight this? Who knows the difference between this address and the address at the airport? Nobody? This is inside the city limits. That is outside. 0.5% difference, guys. Okay, think of all the revenue you're going to make, 0.5%. That's a lot, right? And you actually get charged 0.25% to do business downtown on top of everyone else. So if your business was registered out by the airport, you're paying 0.5% less. If you're registered right here downtown, you're paying 0.5% more. Guess what? That's really important. Take 100 grand, times it by 0.5%, See the number you come up with. It makes a difference. Understand where your nexus is and where you're shipping out. I was so glad to hear that you understood that you were outside the city limits. You don't need to worry about those kinds of things because most people don't. But guess what it impacts? Taxes. So as an example, some people work here. They don't use this as their business address. They use their home address and they're completely allowed to. Why? Save themselves 0.5%. Small, but it counts. Go right ahead.
Few years ago, we had a brick and mortar cinnamon roll shop actually near Cal Poly. And we realized that actually I think it was less, if we were to have a place here in downtown, we would have paid more.
More, yeah.
So even
I
just
can-
that small distance made a difference.
I can give you guys a great example. When I first started working for REC Solar, one of the reasons they brought me on is they had the commercial side and the residential side. And I specialize in the commercial side from a tax reporting perspective. And I did an audit on their financials for the last 3 years, and I discovered that they had been reporting at the city rate. So they had been reporting at 7.5% on $3.5 million worth of revenue, when they should have been reporting it at 7%. So we got to go back and refile and got $380,000 back from the state. That's what I mean. It can make a difference. Now, am I saying that no, but that 0.5% is what makes your business grow. That's the money that takes you to that next level. It makes a difference. We've had this conversation, right? When we talked about you guys getting corporate and where to register, it's something so small, guys, but it really matters in the concept of filing taxes and the cash flow for your business. So keep that in mind. Again, so much of what we talk about today is very specific to your business. I just want to reiterate that after this, I want to sit down with everyone and understand what I can do to help your business grow. A lot of what I talked about is in general terms today, but once we can really start digging in on these key items of how we're tracking, how reporting, how we go about it, this is where the efficiency side comes into play. So less work, more efficiency, less liability, more revenue, more income is the idea behind it. I get this all the time. Okay. And so it starts with these little habits. I had a young lady, she's a middle-aged lady who started her own business. She's a full-time nurse, started her business on the side, basically ended up doing like $150,000 in her spare time doing this business, and came to us and said, I want to actually turn this into a real business. She wasn't an LLC. She was just a Joe Schmo. She got a $60,000 bill, right? Because she didn't know what to do. Well, we spent time together over the last 3 months, and that $60,000 bill is now $12,000. She's quitting her nursing business, and she's starting it full time. Now, this is a lady who is a single mom of 2 children who lost her husband to cancer in a car. Lost her husband to cancer 2 years ago and is trying to rebuild. But it's these kinds of scenarios, that's the lifeblood of what we do here. That's what we want to embrace and encourage for our local community, is people like that, because clearly they have something that works. They just don't know how to go about it. And so I feel like we're all there at different stages of that process as a whole. And so at the end of the day, that's where the knowledge and understanding of what we're trying to embrace. Am I going to answer every question for you today? No. Am I going to sit here as a CPA and go, well, you should be doing that? And no. What I'm trying to get is concepts here that we can then build on. I don't want to give you the fish. I want to teach you to fish. I want you to understand what I'm showing you today so that your knowledge base builds upon this. And you come back and go, hey, Damon, what about this? And I'm going, great idea. Because I'm here to teach and inform you, not tell you. It doesn't do me any good to tell you what to do. I want to teach you what to do, which is why I harbor on some of these things so specifically, because they're so important from the big picture perspective, but we do not give them the time and effort. The 1099, for example. It seems so simple, but it has such a big impact from an overall perspective. Okay. We've taken a look. I want to just jump now real quick into, and I probably should have shown my little video at the beginning, but I want to just touch on, before I go any further today, the resources that are available to you. So I actually just got back from Vegas last week. I was there not partying. I was actually there at a QuickBooks conference for 4 days. They have it every year. It's an amazing program where we get to interact directly with the hierarchy at Intuit. We get to give them feedback. I teach a number of classes here, both to students and the community. So I get to give them feedback about what people are looking for, how it relates. And the reason I highlight this is that Intuit understands that a big part of QuickBooks is the learning section of it. And I've really focused on the last couple of years, encouraging to build out better modules and training modules in regards to doing this kind of thing. Here's what I would tell you. Anything that I'm teaching you today or in any of my classes is available online. The only difference between what I tell you and what they're telling you is the language that I speak. Okay. Sometimes when you can it can get a little technical and it goes, and unfortunately with accounting, especially QuickBooks, if you miss one concept, then everything else that they build upon kind of makes it that much harder. I'm going to share this quick video with you. It's really short, it's really brief, but the point behind it is that anything that you have a question for, somebody has already asked. And whether the Intuit knowledge base, which you can literally go in and type a question and see 50 other people asking the same question and see the 50 different answers, right? Or looking up a simple video on how to prepare tax seasons. It's all there. And so if you start there and know that you have the resources of, here, I'm actually going to blow it out. Know that you have this access to this, plus the resources of the SBDC in conjunction with what we've talked about today, it's going to make life that much easier for you. So one quick video just to highlight what we talked about today, and then we're going to pivot back in. I think I need to turn my volume up, or will it go through? Oh. Do I need to turn my volume up? No?
You might need to adjust your share screen.
Oh, gotcha. I assume.
Just make sure that you have.
Sure.
But sure.
Oh, look at you. Okay.
Bookkeeping and taxes can be intimidating, and that's why it's so important to learn the best practices for recording your company's financial transactions. Transactions and reports in QuickBooks are only as accurate as the information you enter, so entering everything correctly, double-checking your work, and then protecting it is key to getting the most out of QuickBooks. The first thing you learn about in this module is the chart of accounts and how to properly categorize transactions. After that, you learn about reconciliations, why they're so important, and how to perform them. You also learn about closing dates, which is a technique used to protect your business's financial information. Finally, you learn about best practices for using QuickBooks, working with an accountant, and even how to attach documents to your transactions for easy retrieval later on. By the end of this module, you'll use QuickBooks with far more confidence.
So the reason I wanted to show that video is basically, first of all, to highlight the very fact that that was an intro to tax reporting. How many words associated with taxes did you hear him say? Not one. He talked about all the things that we've just spent the last 45 minutes talking about, right? Why? Because all of those things have to take place first. The reconciliation, the closing out of the months, the ensuring that our chart of accounts is set up correctly and being coded to. One of the things that comes up constantly with small teams, especially, and I'm curious if as you grow into those mid-market companies, is the tracking of specific expenses within chart of accounts. So a lot of the time when I'm dealing with incubators and accelerators, not so much more established businesses, product development becomes a really big line item within the tracking of expenses. And having the ability to code those out and the granular detail behind them so that we can claim them as an expense on our tax return and not just have a line item for supplies and materials is key. It's also key from another aspect, and I'm not going to go down through this far, but if you're looking for things like investment and growth in your business down the line, investors want to see the granular detail that are taking place within your chart of account to understand what your revenue lines look like, what your income lines look like, and more importantly, where those funds are going from an expense standpoint. So the whole aspect creates a clearer picture from both your perspective and someone looking at your business as well. Keep that in mind as we move through these modules. The other part that I want to highlight here is you can literally see up on this right-hand corner, if you click on From Intuit, these are all videos that have been generated by either Pro Advisors or Intuit themselves. Anything you can think of can be answered in here. Whether it's an accounting 101, whether it's a salary, whether it's owner's drawer, whether it's a vesting schedule, profit sharing, you name it. We can go down that path. They're simple, they're concise, and more importantly, they speak to a language that everyone can understand. Okay, because again, I sometimes with QuickBooks, we get into this jargon world, and that's where it starts to go over people's head, and we start to have real issues with understanding what's actually taking place. We good on that side of things? Okay. So we actually haven't spent that much time in QuickBooks because what we've been talking about really relates to the details and the transactional details that take place, the invoicing, the accruals, and then ensuring that those are paid in a timely manner. Let's take a look at it from the other side, from the state requirement side. So I'm going to spend a little bit of time here just showing you the state requirement side of what the tax reporting, and then I'm going to correlate it to a checklist that I've actually generated that will walk you through. Man, I have so many windows open. Okay. Let's see.
Hello, everyone, and welcome to How to
Sorry. I'm also going to include a link to the filing of the 1099s and miscellaneous in the emails that go out that will walk you through it. Just differentiating between the two as well from a reporting perspective. And let's turn my volume down. Okay, so at the end of this, I'm actually going to send you out this wonderful document. If you can actually, if I can share my screen. Okay. So one of the reasons that you won't have to worry about taking notes is at the end of this, I'm actually going to send out this business user manual for QuickBooks. It basically encompasses everything I've talked about today. The other part that's great about this is it has the other 3 modules that I teach already built into this. So I do a beginners, which is talks about how QuickBooks gets set up, getting QuickBooks orientated, everything you need to do before starting utilizing QuickBooks. It also goes through my intimate class, which basically breaks out how to invoice, how to set up and pay taxes, how to do payroll, how to do accruals, and most importantly, do month-end reporting. A lot of reporting in QuickBooks can be auto-generated now, automatically emailed to you, whoever wants to see it. As an example, when I was in charge of AR and AP every Monday morning, I tell QuickBooks to have the AR and AP file sent to me automatically. I come in, I know how much money's coming in the door, I know how much money's going out the door. I could take that to my director of finance, he would sign off, we're good to go. Why is that so important? Number one thing that will keep your doors open, cash flow, bar none, right? Every single company, whether it relates to taxes, whether it relates to growth, whether it relates to anything, cash flow. Good news in cash flow, QuickBooks has a whole new module coming out in December with AI built in. Pretty freaking amazing. I'm not going to lie. I've been screaming for this for years. Intuit has a vast amount of resources that they can pull on, and they've never tried to apply it to a cash model. What does that actually mean with what I just said? Think about the fact that Intuit controls about 40% of the payroll market in this country. About 38% of small businesses utilize QuickBooks. Imagine if QuickBooks could look at everything taking place at your bank, everything taking place in QuickBooks, and then project out the next 36 months for you. The only question I have is why haven't they done it already? It knows your utility bills, it knows your groceries, it knows your payroll expenses, it knows what you're paying to taxes, it knows all of it. So it can take that model and model you out based on the industry that you're in, based on the sector that you're in. It can calculate out cyclical factors associated with the specific industry that you're in. And so why do I bring this up inside a tax conversation? Because again, cash flow is the engine that drives everything that we're talking about, which is why we're sitting here talking about lowering our tax threshold so that we have more money to put back into our business. Okay. Lastly, but not leastly. So this manual will go out after this with all the links and the highlights. The one area that I want to talk about in regards to taxes briefly before I share some of the insights into this. Does anyone work with retained earnings here? We've talked about it briefly, what it means, but does anybody else here encounter or utilize retained earnings? And I'm actually specifically looking at EO with your comment about wanting to go to the S Corp and the C Corp. Now, you can't do it currently, but you would be able to do it with an S or a C Corp. Retained earnings, just so anyone understands that it's premise, basic level. It's money that we've earned as revenue that we choose to not pay taxes on now so that we can reinvest it in the business and pay taxes on it at a later date. Okay, there's a myriad of different distinctions amongst that, but at its basic principles, that's what retained earnings is for. So let's say we have a company that made $100,000, right? The director of finance says, look, we're going to take 20,000 and post it as retained earnings. We would only pay taxes on $80,000 worth of revenue. That 20,000 would then be rolled over into the following year and used to reinvest back into the business as a whole from either a growth perspective or an expense, whatever we choose. We would then pay taxes on that at a later date. I am not going to go into the complexities of that because it gets very complex depending on the sector, the industry, and your reporting cycle. But understand that that is the basic premise between retained earnings. And the reason I bring it up is if you are going to utilize retained earnings, you need to have as a line item in your chart of accounts so that we're tracking. Okay.
Is retained earnings, is that the item that's actually at the bottom of the balance sheet, above profit?
Yes, it will be. It will be the last item on the balance sheet before you see the profit line item because retained earnings are a reduction to profit.
Okay, I guess I'm just trying to understand. My understanding was that was money that you had earned in your business from previous years that was sort of added in. Is
Retained
that
earnings, yes, that you have not paid taxes on yet.
okay? I'm missing some sort of a nuance, but okay, all right.
And
I'm
so,
gonna try to
and
follow.
one of the things that should be, and so I'll tell you one of the common mistakes that people make with retained earnings. Okay, they roll it all into one retained earnings. Okay, retained earnings should be broken up by the year, because it's specific to that year. So if you have retained earnings and it's accruing in there, you can go back and run the transaction detail and QuickBooks will give you what the retained earnings were for that year. But from a detail perspective, create the sub account. If you're reporting on a fiscal, if you're reporting on an annual, just have it there so that it's broken out for you. And the reason I like it, this is the CPA talking, is when I come to file for that period, I know exactly what I'm filing for and you're retained. And more importantly, you know what you're filing for. Because what tends to happen is they have it right above that profit line item that you talked about, but it gets dumped. It just, every year you're putting it in, which is fine, because your CPA is the one that's extracting it out. Yes.
Are retained earnings available to LLCs?
Retained earnings are available to LLCs. It is differentiated by state, but yes, retained earnings are the only one that retained. Yeah, no, it is. LLCs cannot do owner's drawers, the significant one that you encounter. Yes. Now there are other methods that we can utilize, but you can't do it. And just to be clear, an owner's drawer is the ability for an owner to draw on the business without paying the taxes at that point in time. Sole proprietor can't do it either. No. That's why the S conversation, and you and I should probably set up a meeting after this to have a further discussion because I'd want to go through it with you. But it certainly starts to look more and more like that the S corp fits your needs, both from an expense and an operational standpoint. Do understand that that LLCs and C corps and S corps also have different filing requirements and costs. A C corp is $2,500 annually now for a filing, where an LLC is $800. So do keep in mind there is a financial burden associated with these entities and how you're filing. Does that make sense? Yeah. Great. Let me stop my sharing real quick and we can jump into this document. Man, we're flying today. Oh yeah, please take a seat, jump on in. Yeah, absolutely, more the merrier. Let me just share this. So just touching on what we just spoke about from an education and keeping yourself informed. The other thing that I wanted to just highlight and share, if I can share my screen. Again, all these links will be available. I did want to just briefly touch on the Education Resource Center. So this is basically follows up from my communication in regards to resources that are available from both filing perspective, webinars, taxes, anything that you can think of that relates to QuickBooks. There is a session that has either been created, is available, is a podcast, is a virtual conference, is an on-demand webinar for pretty much anything you can think of, right? And to be quite honest, they probably do even a whole lot better than I do because they've been trained to do this in many different ways. What's great about these and why I encourage you is if it relates to your business, if it is something, view them, look at them, then reach out to me and we'll build on that. But I cannot overstate the amount of resources that are available specifically as it relates to tax reporting through Intuit. And they're all free, which is the part I love the best. So you can literally get yourself informed about whatever subject matter as it relates to your business, and then you can follow up with me. And so if you look on the lower left-hand side, you'll notice the product side is ProConnect Tax. You know, these are paid services that you can then utilize QuickBooks. Luckily for you guys, I happen to be a pro advisor on all of those. So by joining the SBDC, you gain direct access to me at no charge in the same service. And that's what I want to highlight here is we're funded through grants. We're able to provide this service to the community, to students, people at Cal Poly for this very reason. Those resources out there, please utilize them. Again, I'll include this link when I send out the email after this. Now let's go to, okay. Back into Zoom. So lastly, but not leastly, we are actually going to look at the California Department of Taxation and Fee Administration. And I know that's a long name, but that's the division within the BOE that actually manages the tax filing portion of it. And so I'm just going to spend a little bit of time going through the requirements and how that relates to QuickBooks and how we basically take what we've learned today and apply it against. And again, I'll actually include, this is actually a really great resource document from the other side. So now this is the state's requirements looking at you. Basically, everything we've just talked about will relate to what we've talked about here. You can look at the very top line, seller's requirements under the sales and use tax laws, resale certificate, right? Hawaii, we've talked about it. Types of transactions that are subject to tax, types of transactions, products, services, labor. Labor is not taxable, services not taxable, products are. Use of resale certificate, flow through. We talked about that as well. Am I the end user incurring that tax liability? No. The other benefit to the resale certificate that we didn't account for and didn't talk about briefly is you don't have to accrue for anything. You don't have to hold taxes in hand to then report on. Remember, the number one thing that you will get nailed by the IRS for when it comes to accruing taxes, bar none, they will knock on your door, is if you don't pay it. And this seems really silly, but if you've accrued $2 in tax liability, you need to file for $2 in tax liability. The penalty for you don't get penalized for not paying the $2.25. You get penalized for not filing. Remember that. Even if you're filing for 0, you need to file for 0. You will get fined, you will get penalized. It's not the act of not paying that gets you in trouble. You can file and not pay, and they'll say, great, we just charge you interest, you can pay at a later date. What gets you in trouble, and what got lots of people, is not filing. So I can't overstate how the importance of get registered and file, even if you're filing a 0. And if you're not sure, then sign up to become an SBDC client and meet with me so I can walk you through the process, okay? Really basic, but really, really important. I'm not gonna go into deductions and exemptions, right? It's very specific to the industry and the sector that you're in. If we sit down and go through a process where we're identifying all of these, I can take the time to go ahead and facilitate that. But I don't want to go down this rabbit hole right now because it relates so differently to each one of the sectors that we're in. Really, I really want to just kind of get an idea of what it means to deal with the with the both the federal government, but in this case specifically the Board of Equalization. So what is a sale? A sale is a transfer of title of possession or tangible personal property for consideration. The reason I want to bring this up specifically, that's what you're getting taxed on. It's not the service, it's not the subscription, it's the tangible asset, a tangible product that is being transferred, that is creating that tax liability that we are then reporting on. We good on that? No confusion? Okay. So let's talk about what is tangible property. Tangible property is anything that may have been weighed, measured, felt, touched, or which is of a manner perceivable to the senses. Literally, that's their definition, guys. It can't be anything. So what I say to people, if you can touch it, seal it, or feel it, it gets taxes. If you can't, it don't. It's as simple as that. They said it a whole lot more complicated than I did, but that's it. So here's some great examples. Why am I harboring on this? Because this is where people make so many mistakes from a tax reporting perspective on what should be taxed and what shouldn't. So tangible personal property, again, art, bicycles, toys, clothing, antiques, food, products, furniture, tangible, right? Non-tangible, transfer of artwork, real property, securities, sales of gift certificates by retailers who will be redeem it. That's a great one. I get that question all the time. These gift cards, how are they tracked? How do we do it? So understanding what is subject to tax and what is not, I'm going to leave it with this last part only because I actually don't want to go down TPP, to be honest with you. I just want to look at the common tax components here that we've talked about today. So we actually spoke about this really briefly, and I wanted everyone to have a clear idea of how taxes are made up. We've got the state level. This is looking back a little bit. You've got the local level, which is your county and city, breaking up those percentages, which then comes up with our total. Exceptions to that, Colorado and New York, big ones. Both those states have what's known as educational tax tariffs associated in their counties that can charge up to 25 basis points. Yeah. So when you're reporting in both of those states, you actually have to break it down even further. So instead of going to the city level, you actually have to go to the school district level. There's a third box underneath, only in New York and only in Colorado. It's how they fund their educational system outside the traditional government structure, right? And they have specific bonds, tax-free bonds that fund these programs, and that's why it's structured that way. The point I'm trying to make out of all of this is if you live in the city, you pay a little bit more, and you know that now. If you live outside the city, you pay a little less. County and city count. They make a difference. Where you work dictates what you pay. Any questions there? Oh, and one over here. Okay.
If you are looking for your sales and use tax rates based on, right, okay, I'm located a little bit outside of the city, how would you go ahead and like find out all of that information?
So you would use the address to do it. My best recommendation here is to use the United States Postal Service. But I love Avalara. And I've actually mentioned this to you guys before. So let me show you why I love Avalara. So Avalara is a program that can tag onto QuickBooks as an install that will manage all your tax reporting liability from both sales and payroll, create the accrual, pull the data directly out of QuickBooks, and do the filing for you. When I was using it, it was like $80 a month, and it would just save me so much time that this was 5 years ago. But the particular I like to them is when you want your tax rate by zip code. And so this is what you're actually after. Oh, let me see if tax rate is 93420. One second here. Good question, Ben, just so you know. And the reason Ben's question is really important is you actually need to do an estimate for the state of California. And that estimate is going to be based on that tax threshold, right? So when you start next year, if you incorporate in somewhere, you have to do a prepayment against what your liability is. And how would you know what that is without knowing the rate, the correct rate? Here we go. Yeah.
Don't they have those rates just on the BOE?
They do. You do need to look them up to reference what those rates are, though. What Ben is specifically talking about is can I see specifically what my tax rate is based on my address? And the use postal service is the best way to do that. That's how you can physically pull that rate. And that's how you knew that you were outside the county or outside the city lines, the BOE. You can use the BOE or the post office to do it. So the BOE pulls that information from the post office. So all your tax rates, your county, your zip codes is all the US Postal Office. The IRS, the BOE, all the state entities pull that data from the post office, just so you know. Including the county lines, the city lines, all of it is all dictated by the post office. Most people just don't know it. So that's how you can look up what that rate would be based on. Answer your question. And then you can always, again, we know what the county rate is 5.5%. We know what this, we know what the state rate is at 5.5%. We know what the city rate is at a 0.20, or the county rate at a 0.5. And then we know what the city rate is between 25 basis points and 50. And that makes up the total of what we pay in taxes, right? If you're out by the airport, you don't have to worry about the city side of things. Make sense? You're welcome. So actually, let me share with you. It came right up. And Avalera pulled it, just so we know. So let me show you, Ben, what it looks like. And then you said you had a question as well?
Question online, you are on an accountant's Intuit, can just a normal QuickBooks user access these?
Yes, they can. My accountant version of Intuit that I'm running enables me to receive data directly from my clients that then I can manipulate and send back without the file actually having to ever physically leave. So there's a security apparatus there. To answer the question, yes, you can. San Luis Obispo, we pay 0.75, right? 6% is California. This is your question right here. The San Luis Obispo County charges us an extra 25%. We got 1.5% for the county again. So actually we're paying 1.75 at the county level, right? And then the local tax of 1%, giving us our grand total of 8.75. If you live outside of the county, then you're not incurring this. If you live within the city limits, then you're incurring this. This is for everywhere, guys. You type in the zip code and bring it up. It's right in front of you, black and white. Yes.
How do we get 7.25% for unincorporated Napomo?
What's your zip code? Let's take a look.
93444.
Oops, wrong one. 7.25 right there. So let's take a look at the breakout real quick. Okay, here we go. So again, these numbers matter. Okay, we just looked at 8.75. We are now down to what? 7.25. There's your 7.25, right? We're talking a 1.5 here, guys. So there's your California fixed rate right there. There's your county surcharge at 25%. There's your slow, and there's your total. Okay? 1.5%, guys. It's a big number when you're talking about taxes. Yeah? So don't register your business downtown if we've learned anything, right? Yeah, it's cheaper to go rent a house up in the hill and use that address than it is to do business here. And mind you, we have this too on top of us, which is specific to here. Right? So we actually get charged another 25 basis points for the downtown taxes associated with that. Okay, let's go back to our tax document. So district taxes. So we've talked about this really briefly, county, city, etc. Where this comes more into play is when you start to do business outside different counties, right? As long as you're registered with the state and you're filing with the BOE, you're going to be fine. You do not need to do anything additional in California. You start doing business in different counties, you're fine. Your reporting will be captured when you go to file with the BOE. When does this get a little bit more complicated? Well, we touched it on in the beginning. It's when we start going out of state. Okay, so I'm circling back to this because now we've got a clearer picture of what it means to do business here, what we're paying in taxes, what the breakdown looks like. You're going to have to repeat that. whether we're going to Colorado, going to New York, going to Hawaii, to make sure that it's justifiable for you to do a business. Let's say you bring up and somebody in Colorado calls you and says, you know, great, I want to start doing X amount of dollars a month with you. And you jump in and you go, 9.25% sales tax rate? Well, you've got to factor that in before you decide to therefore go do business in that state. How much revenue do I need to generate before I can actually enter a state where it justifies the expense of being in that state? And guess what, guys? Different states charge more. Different states charge less. Different states have different filing requirements.
DOE versus FTE.
BOE is the overarching organization that collects and runs state. The FTE beneath that is the sub-organization that makes the rules and regulations that govern the BOE. Both documents will be included when I send out the summary. Okay, so district taxes, I want to touch on briefly that if we're in California, we're registered with the Secretary of State and that we are currently filing, we're good. We don't need to do anything additional if we go into those counties. A couple of things to keep in mind. You saw the difference in tax rates in 40 miles, right? If you're going to other counties, other cities, do your due diligence, right? Review the tax rate. Review whether you need to be registered at the city level to do business there. If you're going to have an office, if you're going to do business out of a location, then you need to register with that location. If you are just sending products or services there, then you don't. Understand what that means and how it relates to your business. Otherwise, you will get them knocking on your door going, have you registered this business? Is this business an established entity in this town? Okay. These guys encounter it quite a bit because they start their business downtown. They need to register with the Secretary of State and they go through this cycle so that they have an understanding if they ever move, graduate, and go somewhere else, they've got to repeat that cycle again. Yeah. Okay. I'm not going to go into district taxes, but I'm going to leave. We've got like 20 minutes here that I don't want to go too far. Any next step that I go down will take me down the rabbit hole of how it relates to your business. So I'm going to ask for three things right now. I'm going to ask for any questions that you may have. I'm going to ask for what you liked about today. And more importantly, what you want to see more of from me moving forward. I know this is not the traditional manner in which you were presented. I don't have a clicker. I'm not sitting here going through slides and reading the lines for you because I don't feel that's as productive when we talk about a subject matter like this. Then it just becomes a lecture. I want the interaction. And again, I can highlight to everyone here, schedule an appointment with me. My contact info is in there. I'd love to learn a bit more about you. I'd love to help you and your business out in regards to this. But with this subject matter, it takes the one-on-one time to really facilitate doing that. So let me open the floor up. Give me some feedback and tell me, guys, what worked, what you'd like to see a little bit more on.
You said what? Question. I guess there's three things on the list there, but
Bring 'em on.
one thing that I find that comes up a lot is questions about inventory management
Right.
and how that sort of relates to taxes. So I know that, cost of goods sold and when you're, so I guess that's one of those big rabbit hole type of conversations, perhaps.
So great question. I'll give you the 90-second answer.
Love it.
Okay. And then I'll dig down. So I have a ton of experience working with this side of things. So having worked for a construction company, 46 projects, 23 states, each project averaged between $3.5 and $5 million. Worked for a winery, thousands of bottles of wine, constantly coming in and out of tasting rooms and what have you. Inventory control is vital. Good news, QuickBooks has an amazing inventory control system, like amazing. Key aspect, got to be set up correctly. Most importantly, it relates back to the COGS. In case anyone doesn't understand, COGS, the cost of goods sold. One of the things that's unbelievably good about QuickBooks and its inventory control system is it actually ties back to COGS, which is kind of different from most. So what are we talking about here, Damon? Ooh, COGS, inventory control system. Let's talk about a bottle of wine. So most people perceive a bottle of wine being a bottle with wine in it. Actually, that's completely incorrect. It's a bottle, it's a wine, it's a label, it's a cork, it's the foil thing, and it's the wrapper. Now, you cannot make that bottle of wine without all of those things, right? And the cork costs $2, and the bottle costs $1.50, and the foil costs 37 cents, and the little wrapper thing costs 5 cents, right? And all of that together is $4, right? Well, that's the COGS associated with that product. We then put wine in it and we sell it to the consumer for 40 bucks, right? The system knows that. It knows what it cost you to put that product together. It knows what it costs you to then put that on the shelf and then sell it. So it's calculating out your margins. At the same time, in these tasting rooms, wineries, when someone goes in and purchases a bottle, the inventory system reduces the inventory associated with that specific line item, maps the information over to cost of goods sold, and reduces the inventory by it. The key aspect of all of this is that structure has to be in place for it to do it. What's nice is once it is in place, you have a real-time inventory control system that if a customer calls up and says, I need 40 of this, 40 of that, and 30 of this, boom, 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 the system tells you it's on hand, it's going out the door tomorrow, right? Because at the end of the day, unless I had 50 corks and 50 bottles and 50 labels, I couldn't sell 50 bottles of wine, right? And so understanding the relationship between that two, and more importantly, from a tax filing purposes, because there are accruals that take place and you can structure them depending on, do you sell a product, I'm guessing? What do you?
I'm a bookkeeper
Okay.
and I actually work with a lot of clients that are either, I mean, service-based clients and then product-based clients.
And
So,
product-based clients.
and a lot of people that are small businesses, they do inventory management, maybe like last step, like
Yeah.
is figuring out like, well, wait, I bought all this stuff and I sell all this stuff and now, and so just sort of trying to figure out how to get those together.
Yeah, so what you're actually telling me is they do the inventory system at the end and then they plug the holes.
Kind of.
Yeah, because when I first started in the wine industry, they would do an inventory control system and then it would go, yeah, we're 40 bottles under, and they would go into inventory and go minus 40. Next month we'd be 20 and we would go minus 20. And instead of going, well, what happened to those 20? You want to know what happened to the 20? I'll tell you the truth. Not in a bad way. They were tasters, but they were not capturing the fact that they were using those bottles as tastings for people's tasting. Guess what that is? An expense.
Yeah.
So 40 bottles a month at 40 bucks, guys, do the math. And we weren't capturing that expense because we were going into the inventory system and going, oh, we're off by 40, minus 40, minus 40. I mean, it has to work from you, and it can be as simple as that, but you've got to have the process in place. And just to be clear, their inventory control system is a separate module that adds on, but you can actually build an inventory control system within the COGS side of things if you have the structure set up correctly. So it depends on the product, it depends on the service, it depends how it's set up. I mean, I've worked with everyone from a lady who makes seltzer at the farmer's market to Sexton Wineries who does, $8 million a year in wine sales. So it depends on the industry and the sector that you're in, but yeah, you can do both. Unless you have a real inventory control system in place, QuickBooks is pretty amazing, but you've got to be in that upper echelon of that 200,000 mark to really justify that expense because it's not cheap. Does that make sense? And then it's the proverbial spreadsheet, right?
Right.
And which I loathe, but invariably that's where it comes back to. We should talk.
Yeah.
Are there any nuances or complications when monitoring tax requirements when you are awarded a government grant?
Yes. Yeah, there is. Great question. It's so funny because a number of the teams that I work with in the incubator and accelerator end up getting state and federal grants to fund themselves through the product development side. You're going to want to establish a specific line item within the chart of accounts to track that grant. Grants are non-taxable. And so we really need to clearly segment out that line item so that you are not being taxed on that. Because here's what I've seen on my side. The grant hits the bank account, right? It maps over into QuickBooks and then it's perceived as revenue. And so the moment it's perceived as revenue, then it's coded toward tax. It is not revenue. Okay. And it's not equity either, right? It is just what it states it is. It's a grant to support it. And you want to establish a specific line item so that when your CPA reports on it, you're not paying taxes on it. Yeah. And definitely can have fallout cushions because I encountered that quite a bit. And in fact, I come across teams that have multiple grants and you want to break each grant out separately because there are normally reporting requirements behind the grants that if you set it up this way, will make it a lot easier to report on moving forward. Okay. Same with equity investment. We literally had this meeting yesterday with this team in here about equity investment, family and friends and notes, how they should all be broken out separately and tracked separately. And the reason for that Because we don't want to pay taxes on them, people, okay? We don't. We want them structured correctly so that the system is not perceiving them as revenue or income, more importantly, on the income side, and then we're paying taxes on it. Great question. Great question. Keep them coming. We got a couple more minutes here. Talk to me. What would you like to see more of? What could I go into more detail about without making it too complicated?
I like this system of setup. I
Okay.
feel like previous kind of workshops have been kind of that little bit more of a slide option, but I feel like this is, like you were saying, a lot more versatile. So the system that you're currently running, I think, is really good in the way that you can kind of bounce back and forth with people is really good. So keep that up.
Okay.
I think something that would be kind of helpful. So we are just barely getting into the tax system of like our entire business. Really started in April, technically been around for a year. Something that you were talking about is like, oh, nailing down your closeout procedure. We don't really know what that looks like, or at least I don't. So maybe something along those lines would be something helpful in the
Okay.
future. But yeah, this was super helpful.
Oh, you're
Thank
welcome.
you.
So I'm going to share two other documents that I'm going to be sending out with everyone. One is one that I've actually generated internally to help you work through. Let me get back to my main page here. There it is. So I've generated, let me see if I can actually share this document. So really, I've taken multiple sources to generate, but this is the most simplest way that I can communicate what you're going to need to close out the year, to get everything together that you need. And I'll share it out when I send out the documents today. And it's pretty straightforward. It speaks to gathering your records, your estimated quarterly return, which is probably something you and I need to spend a little bit of time talking about. Property taxes, excise taxes, employment taxes. We didn't touch on employment taxes. I'm staying away from it. Okay. And what that looks like, what taxes do I have to pay as a small business, estimated taxes, self-employment tax, sales tax, property tax, excise tax, and employment taxes. Again, the idea behind this is to simplify this as much as possible and give you a document that just walks you through the procedure. These are based on my experiences. So I've tried to keep this as simple as possible, not use any jargons, et cetera, et cetera. Again, all of this can be referenced online. I just generated this document because I find it a little easier to communicate with people. The other part that I like about this is I break out the different types of entities. So I speak specifically to sole props in here. I speak to partnerships. I speak to corporations specifically and what the filing requirements behind them are. So like you and I will have a further conversation along this. And then I go into what actually physically needs to be filled out, what needs to be submitted from a tax form perspective, which forms relates to which entities, and when they need to be submitted by. I tried to add a little bit of flair into here, and I've copied some information over. So things you want to make sure you have on hand. We've all talked about this already. Bills, bank statements, invoices, and financials. Seems lame. Trust me when I tell you, you want to make sure you have them all on it and they're entered into the system correctly. Know your forms. We spent a lot of time talking about 1099s today. We didn't get into 1120s. We didn't get into the 1065s. So, yep, you got your little cheat sheet there. Love it. I love it. I don't go too far down this rabbit hole, but if we meet one-on-one, I will spend more time going through what these forms mean to you. Again, I'm going to say something I said at the beginning. I don't want to give you the fish. I want to teach you to fish, right? And this is part of that. Lastly, but not leastly, focus on the accuracy of your forms, providing supporting documentation, and can consider using accounting software. Here's what I will share with everyone in this room. Virtually every single incubator and accelerator team comes to me for their returns, right? Do you know what I tell them? Great, I'll teach you how to file it. Do you know what happens when I spend 20 minutes teaching them how to complete an IRS return? They go, oh my God, this is so easy. It's a lot of pages with a lot of numbers and a lot of words, but that's it, guys. If you read through it, it is not an intimidating document. It can be completed by anybody. Take the time. If you're still intent, schedule an appointment with me. Sit down with me. I'll go through it with you. I promise you, it is not as scary as you think, okay? Take a shot. Just try it, and you'll be surprised. And here's why. Nobody knows your business better than who? You know the write-offs, you know the claims, you know what those bottom numbers will look like. Your CPA does his best job, but trust me when I tell you, no one will do as good a job as you will when it comes to that kind of stuff. Lastly, but not least, know your deadlines, right? We talked about financial close, things like that. These simple little operations will really help you ensure that you're reporting in a timely manner, your information is accurate, and more importantly, you're getting the information reported and filed in a timely manner so that you're not incurring penalties and fees. Lastly, consider filing an extension if you're unsure. I can't overestimate this. Look, in California, you don't have to do anything, but any other states that you're qualifying for extensions, you do want to apply to for the extension, right? It's a simple process to do. And trust me when I tell you, you don't want to get on the other side of the IRS. No one will knock on your doors faster than the IRS, the biggest collection agency on the face of the planet, bar none. And that's all I have for everyone today. Thank you so much for attending. We will have a review that will go out after this, seeking your feedback on this particular interaction. Again, I encourage you to give real feedback. Tell me what you liked, what you didn't like, and what I can do better next time. Please ensure that we have all your email addresses. I have quite a bit of documentation that I will send out after this, including the guides, a lot of the spreadsheets that I showed you. Please don't hesitate to reach out to me. Sign up to become an SBDC client. I'd love to sit down and learn a little bit more about your business and more importantly, how I can help you. I have the pleasure of running the CIE's financial aspect, but my true pride and joy is getting to work with local businesses and small startups and helping them grow into something successful to support the great place that we get to call home every day. And I genuinely mean that. So thank you very much, everyone.